like Drake said, we don't fumble. So four, unfortunately, y'all, let me go back a couple slides. Let me re-go over that real quick. Um, so the outline of discussion, I mean the for today, common mistakes that retail traders make, what not to do when trading. Let's get past the disclaimer. We already know about that. Well, let me just leave it on screen for a second. Boom. All right. And then the quote, the only real mistake is the one from which we learn nothing. Henry Ford. Outline the discussion, get rich quick mentality, the one man without a plan mentality, the FOMO mentality, the overly ambitious mentality. So, the get rich quick mentality, making unrealistic expectations, pouring all of your money into one contract, thinking that you are going to get rich overnight, or thinking that after only a short period of time trading, that you would become a full-time trader and quit your job. So next, the woman without a plan mentality, trading without a trading plan, entering contracts without a clear entry or exit plan. These type of traders are easily identifiable because they ask questions like, should I hold? Or when should I take profit? They have no plan on what percentage they will take profit or no plan on what percentage they will cut their losses. They're not writing down their trades in a trade journal so that they can go back and review why a trade did or did not work in their favor. Also, not knowing their risk to reward. Example, are you willing to risk $10 to make $20? Also, for the people who don't have a trading plan or a risk to reward, I have something on that in the market facts and resources. I have a text on it broken down as well as a video. So if you need help with your risk management, you can go there. Market facts and resources. It's numbered now. He did a great job of reorganizing it. So just look there as far as with the risk to reward and when they should cut, when you should take profit or cut your losses. The FOMO mentality, fear of missing out. This is one that causes retail traders to lose the most, feeling like they are going to miss out on hitting big. Let me see what it is. What is it called again? Oh, it's called the risk to reward. If you want to look for it in market facts and resources, it's just the risk reward risk management. That's actually what it's called in there. Anyways, go with this. Um, Fear of missing out. This is the one that causes retail traders to lose the most, feeling like they're going to miss out on hitting big. So they do things like follow call outs without verifying if it's a good call or not. Or they jump into contracts without charting just because it sounds like a good move with no solid foundation built on technicals or fundamentals. Chasing is another portfolio killer. Chasing trades after they are running up so high or even to all-time new highs is not wise because stocks take the stairs up and the elevator down. This is how institutional traders flush retail traders out. So when it pertains to fear of missing out, I know that, for instance, this is the perfect example that Key calls out some slapping plays. And it's like when you see Key call out them plays and you seeing this 100%, 200%, you ask like, oh, yo, is it too late to get in? Or you see that everybody else is winning. So you want to hop in, but you just hopped in when everybody's getting out. So so like, let's say it goes up 100%. Now you're trying to hop in, right? Oftentimes it's somebody that's probably taking profit in the group that's selling it to you. So you never want to just chase plays. You never, just because you're missing out, there will always be another trade that's called out. There will always be something else. Like, don't have fear of missing out. That's going to make you blindly run into plays. And that's why you lose money, because you blindly ran into it. It starts going down. You think it's going to come back. It never comes back. And maybe you average down, you buy the dip that just keeps on dipping. So, next, the overly ambitious mentality. Trading during a choppy market or when it's consolidating and thinking that they can predict the direction that the market will go without waiting on confirmation. Being in way too many positions, not understanding that the chances of them being able to do their due diligence on more than 3 to 5 positions is extremely difficult. Not waiting for confirmation before entering into contracts, entries just like exits are extremely important. Can you everybody please mute themselves? All right. Not waiting for confirmation before entering into contracts. Entries, just like exits, are extremely important. So when you enter into a position, makes a huge difference in whether you would be profitable or unprofitable. And so I'm gonna take this actually back to the previous slide, right? Some people will hop into a play Key or Chris call, right? And they're like, they're up 30%, 40%. What am I doing wrong? I'm not up. It's because of your entry. So while Chris or Key might have paid 0.50 for the contract, which is $50, times 100, you're paying a dollar for it. Of course, you're not going to be up that 30 to 50% that they're up because you just paid a dollar for it. So you paid point 0.50 $50 more than they did. So if you're having that problem and you're saying, hey, um why am I not up like everybody else is up? That's why entries are very important as well as exits. If they say I got 100% on my trade, and you're like, I only got 80%, we got out around the same time, is because the stock may have started pulling back or the IV might have went down on the contract. So that took away from the funds on the contract. So just understand that the entries and exits matter, and that's why they matter. So if you've had that problem, I see that question posed in the study group or just the regular options beginner chat. That is why. How do you know when to enter? So if you go back to the class that we did last time, you can use your indicators to see when you should enter into a trade, depending on the combination of indicators that you choose. Everybody has different indicators that they used on when to enter a trade. Um, So we kind of went over the entry part of it before. Now on the exit, I would say this: try to pick a exit where you see price has previously went before. If you're using something that's hitting all-time highs, you obviously don't have anywhere to shoot for. But stocks that's been in that price area before, you can use those as price targets, or you can use analyst targets as price targets if they're close, if the analyst price target is very close to where you are right now. All right, so let me see. Let me go on. Questions that need answering. Should you sell? Why is it that when we are in profit, we ask the question, when should I take profit? We see the percentage gains, but have no plan on when we should take profit. Or should you hold? Why is it that when we are down a significant amount, percentage wise, we continue to hold with this overly optimistic hope of our contracts recovering or coming back? Question that you should ask yourself. Also, the purpose of this presentation is to help you to understand that trading is 80% psychology and 20% strategy. Understanding this will make a difference in whether you are a successful trader or not. Manifesting successful traders. Now, let me stop the share so we can go ahead and start. So I can look at these questions. If you have a question, go ahead and raise your hand and I will call on you so I don't just jump around. I don't want to miss anybody and I don't want to just mindlessly scroll through the chat. So, all right, let me bring you over here. All right, Tyrell, you can go ahead and ask your question.
Hello, can you hear me?
Yes, I can hear you fine.
Okay, so my question is, when it comes to indicators, like I'm trying to understand, like how do you use like the VWAP, if I'm pronouncing it correctly?
VWAP. Yeah.
Yeah, the VWAP. Like
Hmm.
how do you gauge that
The volume
as
is.
a as
All
an
right,
indicator?
one second, Tyrell. Can you hear me pretty fine? Is my volume low for you?
Yes, I can hear you. I guess because
Okay.
I'm on my phone.
Let me boost it up just a little. All right. So, you said how do you use it? All right. So I don't actually personally use VWAP myself, but I know that Key uses it and he uses it with the non-EMA. So he looks for the non-EMA crossing above the VWAP.
Okay, got you.
So it's not something to be used alone. Basically, what the VWAP is, it's the volume weighted. Um, I forget what the E is. Average. It's basically the volume weighted average price, right? Um, and what typically institutional traders use it for is they're just trying to make sure they're getting filled a good amount on their order, basically.
Okay,
So
got
like
you.
so like let's take for instance, there's 2 points. Let's say a stock for the high was $60, right? And the low was $50, right? The VWAP might say, okay, the average that you should be trying to get filled at is 55. Or
Got
let's
you.
say the VWAP is saying 55. A lot of times institutional traders were trying to get filled in at 54 because they want to get in as low as they possibly can. So they know that if they get in below what the VWAP is saying, that they got filled at a good price.
Okay. So he uses the VWAP and the EMA 9-day moving average, correct?
Right, as well as like a few others. I think it's like the 21. He uses a bunch of them. I think it's in his book, as well as I think he might have put it in the chat before on the indicators that he actually used. But I
Okay.
don't actually know the amount.
Okay, got you. Thank you.
No problem. So now, uh, Yeni, you can go ahead and ask your question.
Hey, good evening. How you doing today?
If you can, up your volume a little bit. You're kind of low.
Hear me better today?
Yeah, I can hear you now better.
Hey, thank you for taking my answer or my question. Sorry, I have a question about quad witching for the 19th. Um, my understanding is all options expire on quad witching, but a lot of the call options that we get into are for like the 26th or the 1st of April. So I'm wondering, if we have call options that are past the 19th, will those call options also expire on the quad witching?
No, it's not gonna actually expire. What's happening is the monthly contracts, like some options, some stocks have, weekly contracts, most have monthly. So they're just saying that the monthly contract of that, like March 19th, those contracts are expiring along with index options, futures, um, those stuff.
It's
They're all
major securities. The major securities are going to be expiring. So if you have contracts that are tied to an expiration date, it doesn't affect your expiration date unless you legitimately have a 3/19 expiration date. So that's basically what that means. The sentiment around quad witching is basically because the major securities are all expiring at one time. A lot of people pull money out of the market because it's an uncertain time, and so what they're doing is they're trying to make sure that no matter what happens, even if quad witching is not bad, because they don't know, they don't want to risk their money. And so that's the reason why we caution, a lot of people to not trade so heavy around this time because the market is full of uncertainty. And for example, the last spot witching, which was in December, it wasn't as bad as September. So you should be fine. Your contract won't expire unless it legitimately has a 3/19 expiration date.
Thank you.
No
and
problem.
and just to add on that a little bit, what's also going on with the quad because everything's expiring, and the institutional traders are also moving their money around, which also, if they're doing a sector rotation, which there was one in September, that's why it was so bad. So that's why people get so worried about it, because they know around that time, that's when institutional traders are also moving their money around and picking new positions. It does, like Kay said, it doesn't happen every time, but when it does happen, you'll notice because it tanks the market.
And I also really quickly wanted to touch on the person who brought up the volume weighted average price. That's basically the average volume over that given period of time. So the way that you would use it is if the EMA 9, if you're using it to day trade, basically the EMA 9, if it crosses above the VWAP, then that's a very bullish indicator. But anything, your price action being above the VWAP or the EMA 9 is a very bullish indicator. But when price action falls below the VWAP or when price action falls below the EMA 9, then that can sometimes signify that it's a bearish indicator. So you're looking for the EMA 9 to cross above the VWAP, and that's bullish. And if the VWAP, if the EMA 9 crosses below, then that's bearish. I also use that as a part of my trading strategy as well.
All right. Don, Demont, you can go ahead and ask your question.
Hey, how you doing? Can you hear me all right?
For the most part, yes.
Okay, cool. Um, as far as using the indicators,
You kind of hold on, Riz, 1 second. You kind of got lower than what you initially said. Can you
I can
up
bring
your
it up.
volume a little
How
bit?
about now?
A little bit more if you
A
can.
little bit more?
Yeah.
How about now?
All right. Yeah, that's good.
Okay, cool. As far as using the indicators to get confirmation, how long are we waiting to look at this confirmation? Is it over a day period? Is it over a few hours or a few minutes? I know this is a basic question also, but
Well, for the most part with that, it depends on the time frame that you're using. And also it's like kind of like the indicator, but I'm gonna let Kay kind of really answer that. She use indicators more than I actually do. But usually like on a crossover, usually it's good, but sometimes they might come back closer together as the period go along. But it looks like she's off mute, so I'll let her go ahead and hit you with that.
Hopefully I don't break up because I'm having connection issues. So just stop me if I break up. But anyways, when you're using indicators, your indicators are going to be based upon time frames that you're looking at, but more so your indicators should coincide with support and resistance, right? So if I'm using an indicator and I see something that I've charted break through a key level of support if I'm doing a call, what I want to see is for that price action to break above and hold above that particular key level. Now, my indicators are going to steer me into a direction that lets me know if something bearish is going on in the market or if something bullish is going on in the market. But what you want to see, I can't tell you how long to wait because nothing is ever for sure like that in the market. But what I can say is you always want to have more than one indicator to confirm the direction that the stock is going in. So it's not more so a time thing. It's more so, okay, what is this stock doing? Am I setting up a high probability trade? Is there any confusion surrounding this trade? Because if there is, that's a trade that you don't want to take. So it's more so what the trade is actually doing or the price action is doing versus how long to wait. I hope that makes sense because again, it's not something that's like I'm going to give it 5 more minutes to see. It's is this trade being confirmed with the indicators that I'm using, and that's basically it.
Right.
Hopefully
So,
that makes sense.
yeah. So a combination basically of
Right.
different factors.
Right. It's basically called areas of confluence. So you're looking to say, okay, so the RSI is showing me that it's at 35. Okay, so the EMA 9 has crossed above the VWAP.
Right.
It's holding above the VWAP. The MACD is curling up. Okay, so this looks solid to me. So that's something that you want to look for. It's not a time thing. It's more so, is this being confirmed by these indicators?
Right. That makes
Okay.
sense. Yeah, that makes
Okay.
sense.
Okay, great.
All right. Akila, you can go ahead and ask your question.
Hi, thank you for taking my question. I know that I'm supposed to pay attention to the volume and the implied volatility. So when I'm looking to buy a call and I'm looking at volume, am I looking at the volume on the call side or the put side? Like when I'm trying to make a purchase?
Well, you would be looking at the volume on that actual contract. So like when you're getting a contract, it's always best to pick the contract with the most volume on it compared to the other contracts. So I know people ask, what's a good volume size or what's a good open interest? It's in relative to the other contracts on that expiration date. So that's what you would be looking at as far as volume, the volume on the actual contract.
Okay, but so I don't need to be concerned about if there are sellers on the other side?
No, you don't necessarily have to pay attention to it. I mean, there's going to be buyers and there's going to be sellers. There's going to be people who think it's going down versus people that think it's going up. But how the stock move, I mean, it just moves based off of how it moves. So could you look at it for more context? Yes, but I don't personally look at that. I just pay attention to the volume on the actual contract because I don't need it to move much as far as like what I'm looking at. Okay, you about to say something?
I'm wondering if she's asking volume in relation to like volume and open interest, or if you're talking about volume on a chart. I'm a little confused because the 2 questions
Yes.
she asked, one of them led me to volume on contracts, and then the other question she asked led me to volume on the chart when she said buyers and sellers. So when you're looking at your chart and you're seeing buyers and sellers coming into the market, you just want to also look at what the price action is doing as well. But if you're looking at your contract,
the option chain I'm referring to.
Yeah, on
okay,
on
okay.
Thinkorswim, there's a option to look at the actual how many people are trying to buy puts versus how
Right.
many people are trying to buy calls.
Right. So one thing I wanna tell you is that it's easy to be a bear in the market. So you're always gonna see sellers because what goes up must come down. So the sellers are almost heavier in most cases against the market than people who are buying calls. So you're gonna see that. That's what makes the market move. But you're concerning yourself with what you're charting and what you're seeing. And if you're confident about what you're seeing, I wouldn't worry myself too much about the sellers on the other side
Right.
because they could be.
Yeah, I was
Okay,
just
charting isn't involved at all in this question. I'm sorry, I'm just strictly looking at trying to understand the volume, totally separate from the chart, just looking at
Right.
TD Ameritrade. So I was trying to figure out, do I need to even pay attention to, like, hey, I'm purchasing, I see there's a lot of volume, but I don't see a lot of puts. So who am I selling?
Right. But although you may think that selling has nothing to do with it, it actually has a lot to do with what you're asking. It has a lot to do with what you're asking. And that's why I threw that out there, because although you may see a lot of sellers in the options chain, that those are people who have charted and who are saying that this is put worthy. So that's what I'm saying. You just have to focus on what you've charted, and if you're confident in the fact that you're doing a call, then that's what you're doing.
Okay, the reason this question came up is because I saw a lot of volume in general, but I didn't see there was not a lot of sellers. So that's what confused me. I was like, should I even buy this? I don't see any puts.
right. I mean, you also have to, like, when it comes to the puts, or why there may be puts, a lot of puts, sometimes you got to think that a lot of people aren't just doing like regular calls and puts. They're actually like straddling and strangling. They're doing like spreads and stuff like that. So a lot of times they might just have a put to cover their position just in case it does go down. So it's a lot of that goes on. That's why I say I don't personally pay too much attention to it, because you don't know if those people are actually betting on it going down or if they're actually hedging their position.
Okay, thank you both.
No problem. All right, Troy, you can go ahead and ask your question.
Hey, good evening, everyone. Thanks for taking my question. You kind of touched on what I wanted to ask before, because I realized that sometimes when like ICurlyCae or Chris put out, hey, you know, I'm jumping on this call or whatever, and then you try to get in, the price is like much different. Even if it's like a minute later or whatever, the price is much different from what they, you know, put out. But I don't know if there's if they start the trade and let it run before they put that out, or it's just that the price has moved significantly since they put it out. Is it that we, you know, like just need to find a position then that suits you to get into that trade?
All right, so basically what I'm kind of understanding what you said, you're asking like, does the position, is it already running or does it run after they call it out? Correct? Is that what you're asking? Hold on. Actually, unmute yourself. Was I
Yeah,
correct in your question? Okay, so
yeah,
like
yeah.
sometimes in some plays, especially like with Keith, it could already be running because he's also a momentum trader as well as he look for other setups. So in some trades, in some circumstances, yes, they're already running. And that's why sometimes he'll be like, this is just a day trade, or it's risky because it might have already ran a little bit already. So, and sometimes, yes, it has already been running. And sometimes when it is called out, the price does tend to jump, because if me as an option seller, if I'm trying to get out my position and I see all of a sudden there's a volume spike in this option contract, I'm going to automatically start raising the price because there's so many people coming in. So, you know, supply versus demand. And sometimes when positions are called out, if there's enough people that hops on it, it does make the actual price of the contract jump up. That's why you have to be quick to it. And that's why if it's jump, I can't remember. I think it might have been XNet or something. It was like 0.50 and then it jumped up to 0.90. At that point, I mean, you can possibly still get in, but it's not too much room where there's going to be enough profit for you. So sometimes if you see that there's a dramatic increase from where the price was called out, sometimes it's just best to leave it alone. It may still run or it may not. So that's why we encourage you to look at the chart for yourself to come to your own conclusion. That way you can know whether or not you should get in or get out when it pertains to that play. Does that answer your question, Troy?
Yes, it does. But part of it though is, like you said, to look at the chart, because by the time you look at any chart or anything, it's probably already gone. But thanks for answering the question.
No problem. All right, Michael, you can go ahead and ask your question.
All right. Hey, what's up, guys? So my question is centered around indicators. So I use Webull for my charting. I just kind of started and learning about it and stuff. So I don't exactly know how to set up my EMAs and MAs. Like right now I use RSI, MACD, and volume. But as far as EMA and MA go, I kind of just keep it as Webull has it standard. And I don't know if I should be changing those or what.
Kay, do you chart on Webull? Because I know me and her both we use TradingView, and I don't
No,
actually
I don't chart on. I don't chart on Webull because of the lag. I actually use TradingView. My recommendation would be to just go over to either stock charts or TradingView.
Okay, yeah. So I guess like a better question would be to ask is how exactly should I have my EMA and MA set up? Like it's right now it's at 5, 9, and 20 for EMA, and for MA is 5, 10, and 20. And I don't really know if that's like a good setup.
So, you got it, Ray?
Yeah, I was gonna just give him like the EMA, MAs that people use. So like a lot of times people are either using the 8 or 9 EMA or the 20 and 21 EMA. And then for the last one, they usually use like 50. So if that's how you want to go ahead and set up your EMAs, then those would be the good time frames. And you can basically use like the same for the regular MAs. But those are the most commonly used. Like the most commonly used is, if I just give the whole spectrum, it's 8, 9, 20, 21, 30, 50, 100, 200.
Okay, so it's basically just seeing what works for me.
Right, because it's going to be based if you're swinging from day to day, or if you're swinging week to week or month to month. But if you're just going to be like day trading, if you got like a cash account, that the 9 and the 21 or the 8 and 20, those are going to be your most used, and you would just wait for the 8 to cross the above the 21, or the 20, the 8 and the 20. If you're using 8 and 20, you wait for the lower time frame to cross above the higher time frame for a bullish confirmation. And when it crosses back below it, that would be a bearish confirmation. And then if you use the RSI to understand if it's overbought or oversold, to also give you more confirmation, as well as if you use the MACD. I can't remember if you said that. You'll wait for the MACD line to cross the signal line. And you can use those three, because it's always best to use them either in 2s or 3s. But like, for instance, in this situation, just if you saw the 9 and a 21 cross, as well as the MACD cross above the signal line, and you waited for your RSI to get into that 40, 50-ish range, those would be all buys.
Okay, I got you. That makes a lot more sense.
Yeah, no problem. Does that answer your question fully?
Yeah, thank you guys. Appreciate it.
No problem. Francia X, you can go ahead and ask your question.
Hi, my question was to piggyback a little bit off of what they were asking a little bit earlier. When they do post, are they going are the posts for options out of the money, or are they in the money? Just because when I tend to look at it, it's like the stock price is lower than the strike price that they're placing.
Yeah, they're out the money because out the money yields the most percentage as far as percentage gain. Like a lot of times you'll see 100%, 500%, 1,000%. I think the RKT play from, I think it was a couple of weeks ago, was like 2,000%. So yes, they're out the money calls. That's what especially Key loves, playing out the money. So was that your only question as far as like whether it's in the money, out the money? They're definitely out the money.
Sorry, it accidentally muted again. My other question was, so like when they say when they have right out the money and they select a strike price of $10, let's say, and it's
Mhm.
at $9.50, but
Mhm.
it doesn't actually make it to $10, how are they able to still make a profit?
Because you don't need to actually hit the strike. You don't need to hit the strike price. You don't need to hit the break even to make money on the option
Okay.
contract. So, like for instance, besides, I know we talk about delta and gamma a lot. Those two Greeks contribute to the contract being more profitable, but also the
Okay.
one that people don't talk about that may also be why they don't make money or their contract is losing is Vega. Vega measures implied volatility. So like let's say you got the contract, but the price only went from, in your example, 9.50 to like let's say 9.70. If when you bought the contract, the implied volatility was 80%. And from that 20-cent move, it shot from 80% to like 100% or something like that, or 110%. That will also make the price of the contract go up, whatever on based off of whatever the Vega is. So those are the three factors that can improve your contract price. But also, if the implied volatility on the contract drops, it can also drop the price of your contract, which is why after earnings, the implied volatility on the contract drops, and that's where IV crush comes from.
I see. Okay, thank you. That was a great explanation because I kept looking at it and I'm like, am I doing this wrong? But just because I know that in the money is less risk, but obviously they're professionals, so they
Right.
know what they're doing. Thank you.
No problem. All right. Kelly, Brown, you can go ahead and ask your question.
Okay, thank you. So I had a question. I'm super new to calls and I've been following for like the last couple of weeks. So I did a call last week and I bought it and then I made money. So I was trying to sell it in that same day, but I was running into an issue of actually seeing like what the profit was. Like I could see it on my I use Robinhood. So on my Robinhood account, I could see like it said plus like a few dollars or like $15 or something like that. But when I sold it, I couldn't see where that money went. So I was wondering how to buy and sell in the same day without like, and actually see where like the profit.
On the contract, it should tell you like what the profit and stuff is. And you said you didn't see where it went once you sold
Yeah,
it.
so like I sold the contract. So like I sold it because it said I was in the plus and I was like, okay, this is good just to start off. So I sold it. But then when I went back into my account to see like what that profit was and looked at like the buying power, I didn't see a difference in price.
I mean, it should be in buying power. That's usually where you'll see it on the contract before you sell it, but also
Mhm.
you'll see it in the buying power, as well as you could also see like on the home page, Robinhood will tell you how much you are up for the day. Now, what might have happened is when you went to sell it, the price might have dropped. So you
Uh,
might have ended up selling it at break even. And that's why you saw no difference.
got it. Okay. Okay.
As well
And
as
then,
I was going to say, Michael said also look in the stock history, you will also see the profits. Because I mean,
oh,
even on the if you go to your settings, I'm gonna do it on my phone to make sure I'm calling out the right settings. If you go to the transfers, the transfers, no, that's not right. Hold on 1 second. Yeah, I think it's the investing tab or something. It should start telling you what you have done or haven't done, or like the statement history. Yeah, so if you go to your statement history in your
mhm.
settings, it'll tell you, where money has come, like when you bought and when you sold, it'll tell you the plus and the minus and stuff like that. So you can look at it that way too.
Oh, I see. Okay, cool. All right, I'll check it out. And then one other question. I just opened an account with Webull just because with Robinhood, I was like almost marked as a day trader because I was doing too much at one time, I guess. So I'm wondering with Webull, if you're able to do multiple calls and like sell the same day without it like marking you as a day trader.
Yes, if you have a cash account, you will be able to, but also you have to wait for your funds to settle. So that's the other thing to be mindful of. Like you won't be able to keep doing it over and over in the same day unless you have the funds. So like, let's say you have 1,000 in your account and then you use 500 on a trade. You only have 500 left to day trade with. And if you
Oh, I
use that too, you have to wait. I think it's like 2 days maybe or a day for it to settle. Because the other thing is if you don't wait long enough for it to settle, you might get, what is it? I forget what it's called. Good faith violations, right?
Yeah,
So some people, huh? Was that Kay? Was that you about to talk? Oh, but
yeah,
anyway,
I was just trying to let you know it was a good faith violation.
okay, yeah. So like, what happened is some people don't end up getting a good faith violation because, like, let's say going back to the 500, you needed to wait for it to settle, but you went ahead and used it on another trade. From my understanding, Kay, correct me if I'm wrong, you only get the good faith violation like if it dipped below 500. Like if you end up making profit on the trade, let's say you went from 500 to 600 and you dropped out the trade, I don't think you would get the good faith violation. Right,
Mm.
Kay? Or am I wrong? Because I know you said you didn't get one.
I can't confirm that because I've never gotten a good faith violation, but I can definitely look into it for you and I can put it out into the community when I find it out for you.
Okay, thank you.
No problem.
Perfect. That was all. Thank you so much.
No problem. Let's see. Tawana, you can go ahead and ask your question.
Hello.
Hello.
Okay. So my question is, I don't know if you ever heard of minion plays.
Heard
Have
of
you ever heard
what?
of that? Minion plays?
No, I don't think I've heard of that.
Okay, so I know this guy. He makes a lot of money off of what's called minion plays, and these are plays that's way out of the money, where he buying like maybe 5 cent, 10 cent contracts,
Mm-hmm.
and he ride it up.
Mm-hmm.
So I was trying to figure out if you're way out the money like that. I mean, what do you base that off on? You know, because sometimes the contract could be expensive. So you figure, okay, let me go down some more. So when you're playing so far out the money, what are some things that you need to look at to see if the contract is profitable or not? If
I
you
mean,
understand my question.
yeah, I understand it. It's gonna be based off of what you expect the the stock to do. If you think it's gonna go up, then obviously the contract is gonna go up in price if it does it, in a good amount of time because the theta decay is gonna be more than the delta once you get so far out the money. That's when it starts to have bad Greeks and stuff like that.
Mhm.
So if you think it's gonna go up, then it's not gonna matter. You know what I'm saying? Like if you think it's gonna go up here soon, which that's probably what he's thinking, and so that's what he's doing, as well as sometimes they be playing leaps, like Michael said, and they buy far out the money because they think that the contract in a year, the stock is going to move a lot, so they're still going to be very profitable. And sometimes people buy, like I said, far out the money because they're expecting a run to come up, or they're buying the rumor and selling the news.
Okay, because I tried it before and the stock had ran up some, but I didn't make anything because it didn't move for me. So maybe I was swayed too far out the money. I don't know.
Yeah, you got to look at
Um,
the Greeks. If your theta is way higher than your delta, then it's not going to really be worth it.
Gotcha. Okay. So my second question is, I heard you talk about implied volatility. So when I'm looking at a contract, what should I be looking at as far as implied volatility? Like what's good to jump, when is a good time to jump in based on that? When it's not a good idea, what percentage does it need to be at?
Can't necessarily give you a specific percentage, but I know for sure a lot of people like to look at, when it's in the T's, not when it's in the 100s. So they might buy when it's like 90 or 80 or 70, but a lot of people don't like to buy when it's over 100%.
Okay, so if it's below, it's possibility that it could be a good time to jump in. Or are you saying the teens?
No, I'm saying the T's like 70, 80, 90.
Oh, okay,
Not saying
gotcha.
like the teens, like I don't know if I've seen a contract that's that low, but yeah, and it's also gonna be based off of how long you holding it. Somebody sees that it's over 100% and they only plan on day trading it, then I mean they might go ahead and hop in. It's gonna be based off of what you are doing and how long you are holding it.
Okay. Okay. Well, that was my last question. Thank you so much. I really appreciate it.
No problem. Janae G, you can go ahead and ask your question.
Hi. So my question is about the quad witching. I just wanted to know, does the impact for this week mean that if you're buying options contracts that expire this upcoming Friday, that is more risky than other weeks?
Yes, it's definitely more risky because you don't know what the market going to do. You don't know if it's going to be really bad, which is not looking like it's going to be really bad, but you never know. So that's why, like, it might be ranging. It might be very choppy this week, where that means it's not really moving. It's kind of like consolidating. So it might just consolidate all week, where, you know, a lot of people get chopped up because they don't know what's the low and what's the high. So that's what makes it risky. That's why we say play light or don't play at all.
And would that apply even to like stocks where the indicators are really strong? In the sense that like, I guess I'm not understanding even in terms of like how institutional traders could affect the market. It seems like with meme stocks or just like newer stocks, when you see them shoot up over like $10 in a day, I guess I'm wondering how much like stocks like those are impacted by the quad witching.
I mean, everything. Go ahead, Kay.
The reason why we say to go in lightly is because it's a lot of uncertainty during this time. Even if you have the best indicators in the world, that doesn't override a lot of institutions pulling their money out all at one time. Because when you think about it, institutional traders are really the ones that move the market. Our, $1,000 or $2,000 or $10,000 doesn't do much to a stock, but someone who's trading with billions
Kay,
and
you're
billions of
breaking up.
dollars, if they decide to pull their money out at one time, is this better?
Yeah, you came
Hello?
back. Yeah, you're good now.
Okay, so if institutions are trading with millions and billions of dollars and you're trading with $10,000, if they pull their money out of the market at one time, no matter how strong your indicators are, it's not going to beat someone pulling a large position out at one time. So even if your indicators are strong, a lot of people are aware of quad witching. And so if the institutions pull their money out, then your indicators don't matter. So that's the reason why we say trade lightly, because I consider myself to be a pretty, decent trader. But even in September of last year, with the most, high probability setups did not matter when it came to quad witching. I ended up losing $4,000 in the course of a few hours. So we tell you to trade lightly for a reason, because there's so much uncertainty. We don't know. We really don't. And people ask, well, how long do the effects of quad witching last? Or when does the effects of quad witching start? It starts as soon as people say, hey, you know what, now will be a good time to prepare. Now will be the time for me to just take it out just so that I don't lose money. And we don't know when they decide to do that. And when it's going to be over is the same ideology. We don't know when institutions are going to say, okay, the coast is clear, let me put money back into the market. So because of that, we just caution you. I mean, it may not even be as bad as last September, you know what I mean? Because last December for quad witching wasn't horrible. We just don't know. And so the best thing that we can do is just tell you to trade lightly, don't go full port because there's so much uncertainty.
I forgot where she went. Does that answer your question? Can't see where she went to. Let me see. There you go. Does that answer your question, Janine?
Okay, thanks. Yes, and then the last part based on what Carly just said. So, and again, I know you guys are not like advisors, but going off of what you just said, if someone wanted to just really be confident that their portfolio wouldn't like change in value, would you suggest like, if you have stocks that you're holding to just like sell them, or is that like extreme?
Nah, that would technically be extreme. If you're confident, you know what I'm saying, trust your gut and go with what you feel.
Okay, thank you both.
No problem. All right. Adonis Johnson, you can go ahead and ask your question.
Yeah, I just want to ask, when you was talking about, I'm very new with the option calls, but I'm very interested in it. When Chris post with the strike price, you guys had a strike price, Curly post with the strike price, you're buying out of the money, right? You're getting your calls out of the money and not into the money, right?
Right.
That's my first question. Okay, I just wanted to make sure of that because I've been kind of hesitant all throughout the week. Like, am I buying in the money or I'm buying out of the money? Okay, so you answered that one. And two, I needed probably to go back and re-listen to this whole Zoom recording again. So would this like be somewhere this be posted so I can go listen again? Because I don't want to ask the same question.
Yes, it'll be in Will Squad University.
Okay, thanks.
No problem. Adam Moeller, you can go ahead and ask your question.
Hey, thanks a lot again for doing this. Hopefully this is not a stupid question, but normally, how much would you recommend to actually just keep as emergency trading funds? Because you guys come out with a lot of good trades, whether it's Kay with a lot of calls and Chris and others, right? But for folks like myself, for example, where I have positions in several mixed stocks, and I think this week, last week, Chris had the same situation where he said he just didn't have enough money to be able to make a position trade, right? Because his money was just tied up everywhere, right? And the FOMO that Kay had come up with was phenomenal, but for some, because your money is already tied up in other stocks, you really can't make that trade. So is there like a best practice to always, at any point in time, try to reserve X amount of dollars for those emergency trades or things that just come out, right, that you think really look good? Does that make sense?
Yeah, that makes perfect sense. And no, it's not a dumb question. You could do like 20 to 30%, you know what I'm saying, set aside, because you should never really be full port, really. You know what I'm saying? Especially with options. Now, if you're investing in stocks, that's a different situation, because some people, divvy up, 60% for stocks, 40% for options. But as far as having reserves, I would say like 20 to 30%.
Okay, perfect. And then the second question is, like, I'm looking at my portfolio right now. One of my calls is in American Airlines, right? I'm up 20%, but my expiration is December 17th, right? It's still a long way to go, right? But it's already up. Under normal circumstances, what I know we're certainly not advising anyone, but you're already up that much. You don't want to get too greedy, but stuff looks like it could be really sweet. What do?
You said you were up 20%, right?
Up 20% with an expiration December 17th. So it's still a long way away, probably the end of the year.
And you said this was airline company, right?
Yeah, American Airlines.
Okay. With everything seeming like it's about to open back up, I would just continue, if I was in that position, to hold, because it's so far away, as well as the sentiment as things are about to start back opening up. But if things start to change and there starts to be a lot of things shutting back down, then I would take profit.
Yep.
You know what I'm saying? Because it's really based off of the sentiment of what the market's going to do. If they say we're about to shut down the country, then I'm definitely exiting that. But they're constantly still talking about things opening back up. And then it's about to be summertime too. Spring and summertime. I skipped spring, but it's about to be like, spring break and all that other stuff. I would just, hold it if I was in a position.
Yeah, I guess it's maybe just calm in the mind when not to get too happy, glad, and greedy, right? Because let's say it was 200% up, and it's still way December, right?
Then I'm exiting. If it's 200%, I'm exiting, and I'm just gonna buy back in on a pullback.
Okay, thank you. And again, thank you and Curly for everything you do.
No problem. Appreciate you. iPhone, you can go ahead and ask your question. We're gonna take like 2 more questions, and then we're gonna go ahead and end it.
Can you hear me?
Yes, I can hear you.
Okay, so when you guys are calling out the plays and everything. I know Chris mostly do like swing trades, and I know some of you guys maybe like do day trading or something like that. It was I know I'm listening to everybody too. I don't want to be sounding redundant, but like, is it mostly, are we setting up for like a month, 2 months, or are we just doing it for a week? Because I know the longer you go out, the more expensive the contract is.
Right.
And the shorter, like within a week, the contracts are cheaper.
Right.
Are we basing it on like a swing trade kind of thing? Like, are we buying them to hold them for a little while and then waiting for the stock price to go up? Or are we doing like a option kind of move? I'm not quite sure on some of them. So, and then just going back to reiterating what other people were saying, like, as soon as you go into there, I mean, I'll get the alert right away. I'll get right into it and it'll be like a whole different price. So I'm like, what's going on here? So I think that's a little confusion I'm having. Like, are we setting it up for like swing trades, or is it for options?
Well, all right, so there's two different call outs going on. There's an options call out, current option ideas, and then there's a whiteboard. Chris changes like the date on it because it'd be like March, or it'd be, it changes with the months and it changes on the day. It's usually like a Monday when he sets it up. Those on the whiteboard are swinging with stocks. The current option ideas is for options. Now, when it comes down to it, Key usually will say if it's a day trade with the option, or if he doesn't say day trade, it's usually, implying that there's a swing, unless it just really pops. And then he will, go ahead and take profit on it. But for the most part, a lot of it is just, day trades and swing trades for that week. Because for the most part, Key does like weekly contracts. Does that answer your question?
Yes, it does. Thank you.
No problem. O'Neal Campbell, you can go ahead and ask your question. We're going to take one more after this one, and then that'll be it. If you, let's see.
Hey guys.
Hey.
So my question, I know we kept going over quad witching. I think that was one kind of, I know it's kind of bad because of the volume that people may be pulling out. Is there any, and I don't want to sound like a woo man in this sense, but is there any instances where quad witching would actually help our situation in the trading?
It would depend on the stock. Like sometimes the stock doesn't go down in quad witching, sometimes it may go up. It just depends. You have to just, either do a screener for the stock or just look at your watch list, see what's going up, see what's going down. Always watch SPY, see what SPY's doing, QQQ, IWM. What's the other one? DIA. Pay attention to your four major ETFs again: SPY, DIA, QQQ, IWM, and see what they're doing. See, and because those are the sectors, and if one sector is still pushing strong in it, then I would look at the stocks in that sector. But overall, nobody really knows. Everything could look good Monday and Tuesday, and then Wednesday, Thursday, Friday is red, red, red. So we don't know, but just pay attention to those things, enter positions lightly, and often look at most of your position as day trades. If you see this week 20 to 60, 80% on a day trade, and you have a contract that's expiring this week or next week, I would just look at it like a day trade. Like I would take my profit, whatever I see this week, entering trades, and just leave it unless it's something far out. I'll type the four major in the chat.
What my recommendation would be for quad witching, because I see that there's a lot of eager people who, just still want to trade during this particular time, which is fine. A lot of what we're saying is because we recognize that there are a lot of new people in the market who may not have experienced quad witching. So what we're trying to do is we're trying to help to minimize your losses. But what you can do if you're still wanting to trade is go and look historically how the particular stock has performed during quad witching. And that at least will give you an idea of whether or not it's even worth trading if you still decide to trade or take the trade. So always go back and look at history. That's something that people should practice, even if you're someone who plays earnings. Go back and see what they've done their last earnings. Go back and see if the stock typically runs up weeks before earnings. If they typically have a lag and they run up weeks after, do they normally fall? Do they normally miss earnings? So in reference to quad witching, you basically would do the same exact thing. Just go and see how the stock performed during quad witching. It's not going to be 100%, a guarantee, because there's going to be a lot of variables, but because of the uncertainty surrounding quad witching, we don't know. We really don't know. We can't tell you to stay in a position. I won't tell you to hold. I won't tell you to sell. I'll tell you to use your best judgment, because we legitimately don't know when institutions are going to pull their money out or when they're going to put their money back in.
Okay, that pretty much answered my question. And then one last thing I'd have to ask is, and I a little bit understand when like those big hedge funds, they do options, and some of it is to like hedge bets. But when they do like options and they're expiring like I would say maybe that Friday or that same day, because I was looking at a particular stock and I seen like some big money ones, they were buying options that were expiring that day. And then some of them were still buying it for next week, but the stock was still going like down. And then I'm looking at indicators to like possibly go up. Is it just because like they're just hedging their money, or is it, should I just, is it possible that, if this wasn't quad witching, like forget about if this wasn't quad witching, is it something that I can, reassure myself with if this was not quad witching?
If they're hedging, I mean, you don't know if they're hedging or if they're not hedging. You know what I'm saying? That's why oftentimes I don't really pay attention to it. Because you never know when somebody's actually hedging and when they're actually betting on it going down. You know what I'm saying? So that's why you just go with your best judgment and look at what you think it may do, instead of like worrying about if they're hedging or not, because it may hit where you want it to go and then go back the other way. You know what I'm saying? You might get what you want out that play before it goes the other way. So that's why I don't personally really pay attention to if they're hedging or if they're not hedging, because you just never know what it's going to do. You don't know if it's going to go up, go down. It might go down first, then go up. It might go up first, then go down. So a lot of times you just got to go based off of what you think it would do and what you see, because you may get what you want out of it, and then they may get what they want out of it. Does that answer your question, O'Neal?
Yes, appreciate you guys.
No problem. And then the last question will be Julius. You can go ahead and ask your question.
Hi guys. I have two questions, and one of them is just for clarity. Can you hear me first off?
Yes, I can hear you.
Okay, great. All right. So the first question is, and this is just for clarity. I think the question popped up a couple of times in the chat over the last few weeks. But when you guys are talking about changing positions as it relates to the quad witching, you are simply talking about contracts, not necessarily selling your long-term holds as far as your stocks are concerned, correct?
Correct.
Okay, great. All right. And then the second question, as far as like buying contracts, like I see it like people when they're posting screenshots and stuff, they're buying like, 5, 10, 15, 20, 50 contracts sometimes of stuff. And I'm trying to, work my portfolio up. So most of the time when I'm buying contracts, I'm buying one or, 1, 2 at a time, at the most, maybe 3. And, when they say as far as pulling out with profit, it's kind of hard when you have, one contract open and you can't really either pull out or you keep it in there. So I'm asking is it better to buy contracts in multiples so you have the ability to pull out profit and still leave the contracts in there, leave money in the contract if it's going up? If the contract is going up and you see it's going up, but you want to pull out for profit, because I guess if you pull it out as soon as you see profit and then you jump right back in, the profit is the difference in what you bought it and for what you sold it for, and you jump right back in, you basically, reusing the profit to get back into play. I heard someone say a second ago about waiting for a pullback and then jumping back in, but is it better to just, buy multiple contracts so you have a little bit more flexibility in what you do?
It really just is going to depend on your trading, strategy and your trading plan. But consider this, consider you enter a trade and you have one contract and you have a 30% gain, right? Your 30% gain, if you have multiples, let's say you had 100, you have a 30% gain multiplied by 100. So there's the big difference. That's something that I learned when I started even buying shares. If I bought a share of a contract or a company rather, and that return was $3, that's not going to move my portfolio too much. But if I bought 1,000 shares with that company and it moves up $3, then I've just made $3,000, if that makes sense.
Right.
So it's the same mentality when you're buying contracts. It's like you're multiplying your percentage gains by however many contracts you have. So what we tend to do is we tend to buy multiple contracts and we chart to see where our price targets are. So if I have a price target set and this particular trade is gearing up to meet that price target, at that point, I might want to pull some of my contracts out because I know that price target level may actually be a level of resistance as well. And we know that sometimes it may, reject that level and it may go down. So instead of risking all of my profit, what I want to do is I want to secure some of my profit at that level. But if I have a good feeling that it might continue to run, I might leave some runners in there. That's what we call runners. So it's a great idea to have multiple contracts because you get to pull some out to secure your profit. And then you also get to capitalize on that run up if it happens, instead of someone who just has one contract and you get excited, you're like, I got to pull it out now. And then everybody is celebrating in the channel like, oh, it's still running. But you're like, I had to pull my one out because I only had one. So hopefully that paints a picture for you.
Oh yeah, definitely. Yeah,
Okay.
it definitely does.
Okay.
It increases the risk significantly buying them, in the multiples, but it definitely makes way more sense. If you believe it's going to go up, that's the reason why you're buying it in the first place. So
exactly.
I got you. Yeah, thank you. Very great answer. Thank you.
No problem.
And also, just to piggyback off that real quick, let's just say you were buying single contracts, but you had 10 positions. Instead of having 10 positions open, you could number that down to 5 and have 2 contracts in each position. Because instead of having 10 contracts, well, technically you would still have 10 contracts, but instead of 10 different companies, you pick 5 different companies and have, 2 contracts in each company. So that's just another way to, look at it. You might have to come down on how many positions you have as far as different companies, but you could also number that down and have more contracts in each position just by cutting some of those off.
Yep, that makes sense too.
And everybody, while we have your attention, I just wanted to say this because I'm very passionate about people who have small account sizes, because I know that a lot of people just want to build up their risk tolerance and, get more money. You don't have to take every trade. One thing that you can do is look at the average cost for every trade that's put out there. If it's $1, $2, $3, then that means you're spending $100, $200, $300. Those would be the ones that I would say, this is not a trade for me, right? Because if you're building up your account size, $100, $200, $300 may be a lot, especially if you're trying to buy multiples. But if you just are patient and you wait for that day to come where something is put out in the community that costs 20 cents, 30 cents, 40 cents, that's $20, $30, $40, right? That's when you should be, this is my trade. This is for me to enter. So don't be one of those people who have to buy or take part in every single trade, especially when they cost a few $100s. That may not be the trade that you may want to enter when you're building up your account size. You may want to wait for, those alerts, or even do your due diligence on your own and find inexpensive trades to get into. But that would be my recommendation. Wait for the cheaper ones to get thrown out there, because they happen all the time. Like Key threw out something the other day that was like 50 cents or 40 cents.
Yeah, but that's the one that jumped to 0.90.
That's okay. That's okay. That's okay. I'm just giving an example. Like they do exist. You know what I mean? So don't burn your account trying to play these $200-$300 stocks, these trades rather.
Facts, 100%.
Let's take one more question.
One more? Okay, bet.
Yeah. Someone
Uh,
said small accounts matter too.
Khalil, I think I said that right. You can go ahead and ask your question.
Hey, so we was just talking about the cheaper versions of stocks, right? And I'm in a company where the contract was only like about $40. So I did load up and I've been in it for quite a while. And just based off the chart, it looks like it'll come back around again. Like right now it's like $3 and it tops out at 6.
Mm-hmm.
And I'm trying to see like what other indicators can I see or use to see if I'm correct on this trade.
So you're trying to see, so you charted it and you see that a previous level of resistance is about $6.
Yes.
Okay, so first and foremost, you want to scroll out, look at your chart on the macro view, or zoom out rather, so you can see a lot of price action and see what the overall trend is. Is it trending up? Is it trending down? Right.
Yeah.
And then you also want to, you can draw a moving trend line. You can see, is it respecting a bullish move, which is what you're expecting. So your moving trend line is going to be like your moving support line, right? Or your moving distance, just depending on what side you're playing on. And then you can also use your MACD indicator, your RSI indicator. You can use your Bollinger Bands. You can use your some people use stochastic CCIs. So you would just use that to confirm, like, is it moving up? Is the overall trend bullish? Does that make sense?
It makes sense.
Okay.
And also, how can I estimate the profit of an option trade?
Use the option profit calculator. It's listed in Market Facts and Resources. So that should help you to see, but typically when you're doing calls, your profit can be exponential. You know what I mean? As long as the stock continues to go up, your profit continues to go up. There's no cap. I don't know of any company that says you can only make this amount per share. You know what I mean? So as long as people continue to invest and the prices continue to go up, then, so does the value of your contract.
Okay. Thank you.
No problem.
All right. That was the last question. We're going to go ahead and get out of here. We thank y'all for tuning in, asking great questions to help other people out, not only yourself. And we will catch you guys in the next class. See you tomorrow on the market. I'm going to be coming with the funny gifts. You know what I'm saying? We're going to be in there. We're going to be making y'all laugh. You know how
you guys, what a
love
great.
y'all.
If you guys like the class tonight, please let us know in options chat, okay? Please be sure to let us know in options chat.
And just another thing, be careful out there, be safe. You know what I'm saying? Everybody talking about these stimmies. I might be out there with the ski mask saying, give me.
All
you
right,
know what
it's
I'm
time
saying?
to go. Bye, you guys. Love you all. Bye.